Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, October 18th, 2024. Just as they did throughout the pandemic and subsequent recovery, American consumers spent more money on retail spending last month than expected. Retail sales rose 0.4% in September, higher than the 0.3% increase widely anticipated. That does not surprise me given the strength of the jobs market. 2 weeks ago, we learned that the U.S. economy added 254,000 new jobs to the economy, far above the 150,000 figure expected on Wall Street. So I've got links in here to both the retail sales report and to the retail spending from 2 weeks ago. So you can take a look at that yourself. But the numbers are good and they're better than expected. So those two data points beg the question, is the economy stronger than expected? Or are Wall Street economists just bad at their jobs? Granted, estimating growth rates is an inexact science, but for the past 3 months, the economic data coming in has far exceeded what Wall Street was fearing in July. Thus far, there is no empirical evidence to support the argument that an economic recession is imminent. In fact, the recent economic data has been strong enough to perhaps dissuade the Fed from making another cut to its policy rate this year. Last month, the Fed reduced its policy rate by 50 basis points, which is 1/2 of 1 percentage point. It also indicated that 2 more rate cuts this year are likely, totaling another 50 basis points. Now, only 1 more rate cut may be in the cards for this year, and it is more likely to be 25 basis points if the economy continues along its present course. Meanwhile, gold traded above $2,700 an ounce yesterday for the first time ever. Also, the CBOE Volatility Index, or Fear Index, remained stubbornly high this week. So those two data points suggest that a lot of institutional money managers are heading their portfolios. So here's the price of gold. And as you look at it over the course of this past 12 months, up almost 50%. So here now again is retail sales. Let's go over now to the VIX to show you how Wall Street's kind of hedging their bets. So here's the VIX for the past year. This huge spike in August when there was the unwind of the so-called Japanese yen carry trade. So ignore that. You've got a big peak back here in April, another big one here last month. But by and large, the VIX is trending about a third higher than it was during the first half of the year. Apparently, the pros on Wall Street are having trouble believing that the American economy is as strong as the incoming data suggests that it is. They can't afford to miss out on the stock market's big rise this year, but they also don't want to risk taking a big hit if the economy suddenly sags. That's why they are aggressively buying put options on the VIX at the same time they're driving the major stock indexes to record highs. That's also why the yield on the 10-year Treasury note is back up to 4.1% after dipping below 3.7% 5 weeks ago. Simply put, portfolio managers have been selling bonds and buying stocks. They've also been buying gold and put options on stocks to protect their investment. I expect that behavior to continue at least through next month's general election. And depending on how that goes, Wall Street may continue operating in that mode into next year. As the old saying goes, if it ain't broke, don't fix it. And right now, it ain't broke. That's this week's PF update, and I look forward to talking to you another week. Thank you.